The majority of our questions can be answered using Pub 4012 or Pub 4491. There are times we will need to search further for answers by utilizing Pub 17 or irs.gov. The goal today is to assist you with where to go to find answers to the questions on the test, not necessarily to give you the answers. Also, keep in mind during these tests that although we do not file taxes for clients who need to file as married filing separate, because Wisconsin is a marital property state, we still need to answer the questions as if we do. There are some important sections of Pub 4012 and Pub 4491 that should be read entirely before beginning your test. In Pub 4012, be sure to study how to use this guide and legislative extenders. In Pub 4491, make sure you read fully sections Important Changes for 2021 and Temporary Provisions. Pub 6744, Test Retest, page 34. Basic scenario, Joe Wilson. Interview notes. Joe is 35 years old and has never been married. Susanna, age 12, is Joe's niece who lived with him all year. Joe provided all of her support and provided over half the cost of keeping up the home. Joe elected not to receive the advanced child tax credit payments. He earned $42,000 in wages. He is blind and cannot be claimed as a dependent by another taxpayer. Joe and Susanna are United States citizens, both have valid Social Security numbers, and lived in the United States the entire year. The first thing we need to think of is what filing status should be used. Open your Pub 4012 and follow the chart on page B8. We're going to start up on the top here. Were you married on the last day of the year? No, he was not. Did his spouse die during the year? No. Do all the following apply? Your spouse died in 2019 or 2020 and you did not remarry before the end of 2021. The answer to this question is no. Therefore, we have to go down to the next portion, which says, do both of the following apply? You paid more than 1/2 the cost of keeping up your home for the required period of time. We know that to be true. A qualifying person lived with you in your home for more than 1/2 the year. Qualifying person. Let's look to see who a qualifying person might be. Who is a qualifying person qualifying you to file as head of household? If the person is your qualifying child, it is not, it's his niece. Qualifying relative who is your father or mother, again, his niece. Qualifying relative other than your father and mother. She lived with him for more than 1/2 the year, and he can claim her as a dependent and is one of the following: son, daughter, stepchild, foster child, or a descendant of any of them, his brother, sister, half-brother, half-sister, or son or daughter of any of them. There you have it. This is his niece. So therefore, it's a daughter of either his brother, sister, half-brother, or half-sister. So what does that make this person? This makes this person a qualifying child. Now, if we go back to the determination of filing status decision tree and continue on in the lower bottom left box where it says, do both of the following apply? We already determined that he paid more than 1/2 the cost of keeping up the home. And the second part of that is a qualifying person lived with him more than 1/2 the year. We just determined that she was his qualifying person. So yes, they both apply. Therefore, he can file as head of household. If you are still uncertain, you can continue to the pages following in your Pub 4012. You can also find more information in Pub 4491, beginning on page 4.1. Something we rarely see at our site are folks who are blind. Let's find out how that affects his tax return. The only thing this affects is his standard deduction. Turn to page F1 in your Pub 4012. Notice the asterisk in the first box and the explanation. Don't use this chart if the taxpayer was born before January 2nd, 1957, or is blind, or if someone can claim the taxpayer as a dependent. In this case, we're going to go further to see the chart on the following page because he is blind. We now need to go to the next page to the chart at the top of the page. He is 35 years old, which makes him born in 1986. We can't check that box. Therefore, we can only check the one box for him showing that he is blind. You will see the standard deduction for head of household with one factor is $20,500. This is an increase of $1,700 because of his affliction. Be sure to turn to page Roman numeral 7 in Pub 4491 under Important Changes for 2021. Contact a site coordinator if you have any questions. Pub 6744 Test Retest, page 36. Basic Scenario 2, Chris and Marcy Davis. Chris, age 22, and Marcy, age 24, are married and will file a joint return. They cannot be claimed as dependents by another taxpayer. Chris and Marcy have no children or other dependents. They both work and neither are full-time students. Chris earned wages of $18,600 and Marcy earned wages of $6,500. They are both United States citizens and have valid Social Security numbers. They did receive the Economic Impact Payment 3 of $2,800 in March of 2021. These taxpayers can be considered lower income. The Earned Income Tax Credit was designed as a somewhat equalizer for this purpose. Let's find out if they qualify. Go to the table of contents in Pub 4012 and find the section for the Earned Income Tax Credit. That would be tab I. Here is a summary of the Earned Income Credit eligibility requirements. The rules for everyone state they must have a valid Social Security number, they can't be married filing separate, they must be United States citizens, they can't have foreign earned income, their investment income must be less than $10,000, and they can't be the qualifying child of another person. They fit all these categories. Therefore, we will move on to Part C. Part B says if they have a qualifying child, which we know they do not. They have to be at least 19 years old. They aren't dependents of another person. They lived in the United States more than half the year, and they aren't qualifying children of another person. Now let's look all the way to the bottom of Part D. The maximum income for a couple filing jointly is $27,380. They do fall below this, so therefore they do qualify for the Earned Income Credit. The rules for the Earned Income Tax Credit were expanded for 2021 only at this time. Be sure to turn to page 2 and 3 in Pub 4491, Temporary Provisions, for more information. They received $2,800 for the third economic impact payment. When filing taxes, these are referred to as the Recovery Rebate Credit. Is this the correct amount? Let's turn to page H8 in Pub 4012. Look way down at the bottom. You will see the last line says your EIP 3 was less than $1,400 or $2,800 if married jointly. So they did indeed get the correct amount. Just a quick update. The screen that you see in your Pub 4012 has now been changed to look at the third round of payments only. I know this is very confusing to those of you who are newer, but sometimes when the Pub 4012 comes out, they don't have all of the screens updated. So this is the actual screen you will see when you do the recovery rebate credit, not the one showing in your Pub 4012. For more information, turn to Pub 4491. Begin on page 28.1 under the Payments and Miscellaneous Refundable Credits section, and again on page 28.5, the Economic Impact Payment and Recovery Rebate Credit section. Contact a site coordinator if you have any questions. Pub 6744, page 36. Basic scenario, Archie and Tina Reynolds. Interview notes are, Archie and Tina are married and always file married filing jointly. Archie earned $32,000 in wages and Tina earned $24,000. They paid all the costs of keeping up a home and provided all the support for their two children, Laura and Timothy, who lived with them all year. Laura is 13 years old and Timothy turns 17 in November of 2021. Archie and Tina elected not to receive the advance child tax credit payments. They did not have enough deductions to itemize, but they did contribute $1,700 to their church, which is a qualified charitable organization. All four of them are United States citizens with valid Social Security numbers and have lived in the United States for the entire year. Let's look at the child tax credit section in Pub 4012. Let me mention here that the rules for the child tax credit were temporarily expanded for tax year 2021 only. You will find more information in Pub 4491 under the Temporary Provisions section, which you will be reading in full on your own. Now we need to find out if both their children qualify for the additional child tax credit. When we look at the table of contents in Pub 4012, we find we need to begin study on page G2. Halfway down this page, you will see the section for qualifying child. Number 1, were they under age 18 at the end of the tax year? Yes. Were they U.S. citizens? Yes. Were they claimed as dependents? Yes. Were they their son or daughter? Yes. Did they provide over half of their own support? No. Did they live with the taxpayer for more than half of the year? Yes. Did they have Social Security numbers? Yes. So as we go down all of these qualifications, we do see that both of their children do qualify for the additional child tax credit. The Reynolds contributed $1,700 to their church. In tax year 2020, a deduction for charitable contributions by taxpayers who did not itemize maxed out at $300 per return. This amount is subtracted from the gross income as an adjustment. For tax year 2021, this deduction was expanded. Turn to page E1 in Pub 4012. Down at the bottom, you will see for tax year 2021, married couples filing a joint return may deduct up to $600. All other filers, $300. This deduction, again, does not reduce the adjusted gross income, but is an adjustment to the total income. More information can be found in Pub 4491 under Temporary Provisions. You'll see much more information concerning this benefit also in the Standard Deduction and Tax Computation sections. Contact a site coordinator if you have any questions. Pub 6744, page 38. Charles and Heather Brooks. They're married and will file a joint return. Heather is a United States citizen with a valid Social Security number. Charles is a resident alien with an ITIN. Heather worked in 2021 and earned wages of $31,000. Charles worked part-time and earned wages of $12,000. The Brooks have 3 children, Emma, 11, Liam, 13, and Grace, who is 18. They elected not to receive the advance child tax credit payments. They provided the total support for their 3 children who lived with them in the United States all year. All 3 children are United States citizens and have valid Social Security numbers. We discussed the 2021 age rule for the child tax credit in the last scenario. Do all 3 of the Brooks' children qualify for the child tax credit? The first qualification is that they be under 18. Only Emma and Liam qualify here, and they both meet the other qualifications for the child tax credit, such as U.S. citizens, dependents, the son and daughter. They didn't provide half of their own support. They lived with them more than half of the year and have valid Social Security numbers. Again, Emma and Liam do qualify for the child tax credit. You can see more information on this when you go to Pub 4491, Temporary Provisions. And keep in mind that at this time, the rules were only expanded for tax year 2021. Grace is 18. Would she qualify for the credit for other dependents? Let's turn to page G6 in Pub 4012. More information can also be found in Pub 4491, beginning on page 24.1, Child Tax Credit and Credit for Other Dependents. Step 1. Is she the qualifying relative dependent? Yes. Step 2. Is she a qualifying relative with a Social Security number? Yes. Step 3. Was she a qualifying relative who was a United States citizen? Yes, on all 3 accounts. Therefore, they can claim Grace for the credit for other dependents. How about the Earned Income Tax Credit? We found information about this credit before by going to tab I-1 in Pub 4012. More information can be found on page 29.2 of Pub 4491. Do you have any thoughts? Let's begin with the rules for anyone. The first rule is that taxpayers and qualifying children all must have Social Security numbers that are valid for employment. When we read the interview notes again, we see Charles has an ITIN. Therefore, they do not qualify for the Earned Income Credit. Contact a site coordinator if you have any questions. Pub 6744, page 38. Basic Scenario 5, Alan Carmichael. Alan is single and 71 years old. Alan works as a greeter at the local department store and earned wages of $6,000. Alan also received Social Security benefits of $14,500. He received a taxable pension of $11,700. He retired from his previous job on October 30th, 2019. During his career, he contributed pre-tax dollars to a qualified 401k retirement plan through his employer. Alan cannot be claimed as a dependent by another taxpayer, and he is a United States citizen with a valid Social Security number. We're going to talk a bit more about the Earned Income Tax Credit. We have discussed this before, so let's go back to tab I-1 in Pub 4012. Again, you will find more information on page 29.2 in Pub 4491. We'll go through the rules for everyone. Does he have a valid Social Security number? Yes. Is he married filing separate? No. Is he a United States citizen? Yes. Is he filing foreign earned income? No. Is he a qualifying child of another person? No. He meets all the rules for everyone. He has no qualifying child, so let's look at Part C. Is he over age 19? Yes. Is he a dependent of someone else? No. Has he lived in the United States more than half the year? Yes. And again, is he a qualifying child of another person? No. So far, so good. Now we'll go down to Part D. Did he have earned income or adjusted gross income of less than $21,430? Let's look what his income would be. When we add his earned income plus his taxable retirement income, you see his adjusted gross is $17,700, which is less than the maximum. His Social Security is not taxable in this case. He meets all the qualifications for the Earned Income Tax Credit for 2021. The rules for the Earned Income Tax Credit were expanded for 2021 only at this time. Be sure to turn to page 2 and 3 in Pub 4491, Temporary Provisions, for more information. There is another credit Alan may qualify for because of his age. It is called Credit for the Elderly or the Disabled. Let's go to Pub 4012 and find this credit on page G18. More information is also found in Pub 4491. We'll go down the steps. Step 1. Was he married? No. That takes us to step 4. Was he a United States citizen? Yes. That takes us to step 5. Was he 65 or older at the end of the tax year? Yes. He qualifies in this step, and now we need to go to figure B. We calculated his adjusted gross income previously at $17,700, and his Social Security benefits were $14,500. When we look at the single category, we see he is not only over the AGI, but he is also over the non-taxable Social Security. Alan does not qualify for the credit for the elderly or disabled. We should talk a little bit about required minimum distributions. This information is on the test and is provided only to help you answer questions taxpayers have about RMD distributions. The RMD distributions themselves are reported on Form 1099-R and are included on the return. Does Alan have to take a required minimum distribution in 2021? We need to find the latest date of these three. He is not yet 72. He was only 69 before January 1st, 2020, and he retired in 2019. By process of elimination, we can ignore the last two questions. He will need to begin taking a required minimum distribution by April 1st, 2023, which is the year after he turns age 72. Note these rules do not apply to Roth IRAs because taxpayers have already paid tax on those funds, and it doesn't matter when they are withdrawn. Contact a site coordinator if you have any questions. Pub 6744, page 39. Last one, Bobby Daniels. Bobby was separated from his spouse for 10 months in 2021. Bobby and his spouse have decided to file their tax returns as married filing separately. Bobby earned wages of $11,000 during the first half of the year. Bobby lost his job in July and received a total of $7,500 in unemployment compensation. Bobby is a chef and took a gourmet cooking class at the community college to improve his cooking skills. He paid the cost of tuition and a course-related book. His total education expenses were $1,500. Bobby also paid student loan interest for the courses he previously took to earn his bachelor's degree. For 2021, he paid student loan interest of $350. Bobby does not have any dependents, and he is a United States citizen with a valid Social Security number. This is one of the test areas where we have to understand marrying filing separate, even if we cannot prepare them in Wisconsin. What do we know about his unemployment compensation for 2021? Is his unemployment compensation taxable? Let's look at Pub 4012, page D1. Now that's confusing. Wasn't some of his compensation tax-free in 2020? Turn to page Roman numeral 5, Important Changes for 2021, in your Pub 4491. It reads, for tax year 2020 only, the first $10,000 of unemployment compensation is not taxable for most households. This tax benefit is only available to those whose modified adjusted gross income is below $150,000 during 2020. We discussed credits at the beginning of this class. Does Bobby qualify for the Earned Income Credit? I'm sure you remember where we look for that in the Pub 4012 for that information. It can be found under tab I-1. We could also find that information in Pub 4491 under the Earned Income Credit section. There are two education credits, the American Opportunity Credit and the Credit for Lifetime Learning. Does Bobby qualify for either of these? Let's turn to J5 in Pub 4012. Publication 4491, the training manual, has additional information in the Education Credit section. First, let's look at the American Opportunity Credit. The fourth box down tells us he cannot have finished 4 years of instruction to qualify. We know he has his bachelor's, so he has already finished his 4 years. He does not qualify for the American Opportunity Credit. When we look at the rules for the Lifetime Learning Credit, we see in box 4 it is available for all years of post-secondary education to acquire or improve job skills. He is a chef and he took classes to improve those skills. It seems he qualifies for this credit, but let's go on. To J6 in your Pub 4012. This gives us more rules. Let's look at the who can't claim this credit. He is married filing separate. He does not qualify for this credit. How about the student loan interest that he paid? Is that a deduction or a credit? We can find more information on page E11 in Pub 4012. An alternative place to find more information is in Pub 4491, Adjustments to Income. For the loan qualifications, it must have been taken out solely to pay education expenses and cannot be from a related person or under a qualified employer plan. The interview notes are rather vague on who the loan was from. The fact that they did not say something like from his parents leads us to believe this was a qualified lender and a qualified loan. I therefore think the loan qualifies for this deduction. The student qualifications are next. Was this taken out for him? Yes. He is married filing separate. He cannot deduct his student loan interest. This is a quote from Pub 4491, Chapter 17, page 15. Who is eligible for the deduction? Generally, a taxpayer can claim the deduction if all of the following are true. The taxpayer is not using the married filing separately filing status. The taxpayer will not be claimed as a dependent on someone else's return. The taxpayer is legally obligated to pay interest on a qualified student loan, and the taxpayer paid interest on a qualified student loan.